Okay, good day, everybody. Hope you're starting off your day well this morning. We're going to continue on today and finish off chapter 11, talking about the revenue receipts cycle, receivable, okay, revenue receivable receipt cycle. And we left off the other day, we started talking about the internal control assessment that auditors have to make to determine the level of control risk that exists in their audit client. And the reason they have to, again, assess control risk is because control risk is going to affect detection risk. And by detection risk, we're referring to the amount of substantive procedures that auditors must perform. So the auditor decision around the level of internal control risk affects the nature, the extent, and the timing of the substantive procedures that the auditors perform. We talked the other day about the various accounts on the current PowerPoint here, number 21, the various accounts in the revenue receivable receipt cycle. So the major ones being sales in the income statement, and on the balance sheet, the accounts receivable account and the cash and bank account. The other accounts affected, of course, would be bad debt expense, because that relates to the value of the accounts receivable on the balance sheet. And then on the income statement, sales returns and sales allowances, sales discounts. We also noted, although it's actually part usually of the purchase payable payment cycle, the fact that inventory is updated in computer systems that use the perpetual system as items are sold. But again, the inventory cycle, we'll talk about in chapter 12. We talked about the fact that auditors will use questionnaires, and we refer to Appendix 11A the other day, internal control questionnaires, which just essentially list the most common controls that should exist in the revenue receivable receipt cycle. And the auditors complete that control questionnaire. So that's part of their documentation to determine whether the internal control system over the revenue receivable receipt cycle is strong or weak. We talked about the fact that auditors prepare flowcharts as a backup, basically, to their internal control questionnaire. And we looked at a couple of flowcharts at the end of chapter 11. And the auditors do what's called a walkthrough of those flowcharts. And that just confirms that the procedures are actually taking place in the revenue receivable receipt cycle based on the flowchart that the auditors prepare. In the flowchart, it indicates where the internal controls exist in the system. So as you can see, the auditors do a significant amount of work around internal control assessment, of course, with the desire to reduce, right, the substantive procedures as much as possible in a particular set of circumstances. Now, when the auditors, going forward, when the auditors complete their internal control risk assessment, the types of controls they look at, in essence, are two types. So auditors address what's called general controls. So if you look at page 458 in the text, you'll see there's a list of and reference to general controls. General controls are controls that exist in the accounting system for all cycles, okay? So on this particular PowerPoint, they talk about segregation of duties or segregation of responsibilities. There should be segregation of responsibilities in each of the cycles that we're going to talk about. In Chapter 11, revenue receipts, receivables, right? Chapter 12, we'll be talking about purchases, payments, and payables, okay? Chapter 14 is about payroll. And so each of these cycles, there should be proper segregation of duties. Also, for persons that have access to cash or handle cash, so that could be, again, in various cycles, companies should consider bonding. Bonding of key employees provides an insurance policy in cases employees, for some reason, decide to commit a theft and steal cash or other assets from the business. Okay, so especially in operations such as banks and trust companies, the tellers are usually bonded by an insurance policy. Now, in addition to these general control considerations, which exist in each of the accounting cycles, there's a subset what are referred to as application controls. So application controls are controls which are relevant to each particular cycle. Okay, so in this particular PowerPoint, at the bottom half of it, it says the control structure should provide for detailed checking of business rules or policies. So this detailed checking, these are the application controls. Okay, so for example, the application controls in these revenue receivable receipt cycle will be different than the payroll cycle, which will be different than the cycle we talked about in chapter 12, payable, payment, and purchases, payable, and payments. Okay, so the detail, of course, is different in each of the cycles, but there should be application. Well, by the word application, we're talking about the revenue receivable receipt cycle is an application. Right? Chapter 12, purchases, payable, payments is an application. So we have different applications, and of course we need different controls within each application. So as an example, in PowerPoint 23 here, we see it refers to, there's a typo here, so written sales orders, right, should only be completed in a business if a customer order has been received. Secondly, we should only record a sale in an account receivable from a customer if all shipping documents are properly in place, have been properly completed. Thirdly, it says the quantities on the bill of lading. So the bill of lading is the document that goes to the customer that shows the quantity of goods that have been shipped. So the quantity of goods that have been shipped should be agreed to the order, right, submitted by the customer, and the quantities for which they're being invoiced. We want the quantities on each of those documents to be the same. And if they're the same, that means that the number of goods that the customer ordered equals the number of goods being shipped, which equals the number of goods they're being invoiced. Right? So the matching of the quantities would be an application control within the revenue receivable receipts cycle. Okay, so of course, there are many application controls within each of the cycles. And those detailed application controls are also on the internal control questionnaire. So again, if you go back to Appendix 11A, which has the internal control questionnaire we looked at the other day, there are general controls and there are application controls. Okay, so you might want to revisit that internal control questionnaire to have a look at the different types of controls. Now, in terms of the detailed controls, or the application controls within the accounting cycle again, this particular PowerPoint refers to Exhibit 11-4, which is on page 461. Okay, and you'll, if you turn to that on page 461, it'll show you the various application controls for the various accounts, sales, accounts receivable, and receipts, and it will show you how auditors test, okay, the controls within each of those systems. So we'll pick an example here. On sales on page 461, it says the auditors would select a sample of shipping documents, scan shipping documents for missing numbers, right? So the quantities, for example, should be on the shipping documents. And we're going to trace the quantity on the actual shipping document to the invoice to make sure that goods shipped were invoiced. And you'll see over to the right-hand side, that satisfies the assertion of completeness, right? So management wants to ensure all goods shipped are invoiced, right? And of course, the auditor wants to ensure all goods shipped are invoiced as well to ensure that all sales are recorded. So that covers the audit assertion of completeness. And so you'll see on page 461, right, a number of detailed control tests that the auditor would perform with respect to the various objectives that are listed on page 461. With respect to the revenue cycle on the PowerPoint we're looking at right now, it states cutoff is very important, of course, because cutoff refers to sales being recorded in the proper period, right? So if we're looking at December of 2020, we want the December of 2020 to only include December 2020 sales. We don't want December of 2020 to include sales from January of 2021, and we don't want it to include sales from November of 2020. Right? We want all of our sales recorded in the proper accounting period. Okay. With respect to our control risk assessment that the auditors perform, right, always keep in mind that the reason we're doing the assessment of internal control is to determine the nature, the extent, and the timing of the substantive procedures. By nature, we mean, are we going to do tests of detail, or are we going to do analytical procedures? The extent of tests refers to how many items are we going to look at. And then the timing refers to, are we going to do the substantive procedures just at the end of the year, or are we going to do some of these substantive procedures earlier in the year? Okay, so these are all questions that the auditors have to ask based on their assessment of internal control in their audit client. The summary, it shows you on PowerPoint 25. If the auditors determine that the internal control system is strong, or what they call the client has good internal control, that means the control risk is low, right? Remember, control risk is the risk that the internal control system will fail to detect, prevent, and correct material errors. So if a client has strong internal controls, which most public companies do, the control risk that the auditors determine is low. If control risk is low, and we want to keep audit risk at 5%, that means the detection risk can be allowed to increase. Remember, detection risk is the risk that the auditor takes that their own procedures will fail to detect and correct a material error in the financial statements. So when the auditors allow detection risk to increase, as we see in the PowerPoint, it means they will look at fewer items, right? They'll have smaller sample sizes, and they'll do more of their work before the end of the year because they're going to rely more on the internal control system to detect and correct material errors in the financial statements. On the other hand, if the auditors assess that the internal control system is weak, right? So if it's weak, that means control risk is high. So there's a high risk that the internal control system will not work. Well, in that case, with control risk being high, that means the auditors must lower detection risk in order to keep total audit risk at no more than 5%. How do auditors lower detection risk? They have to do more work, right? So more work means they look at more items, so they have larger sample sizes, and they're going to do more of the work at the end of the year because they're not going to rely on the internal control system, right, to find errors that may be arising during the course of the year. So again, this is all in the auditor's judgment, right? So you can see how important it is that auditors have proper judgment, which of course is developed over time. Very often, students will ask me, "Oh, sir, once we get done this course, will we have professional judgment as it relates to internal control?" Definitely not, right? This takes years to develop, right? It's like being a surgeon in a hospital. When they graduate from medical school, right, surgeons are not doing heart surgery on day one, right? They develop specialties, they get trained over 3 or 4 more years, and then after they assist on surgeries for a few more years, then they start doing surgeries on their own, right? It's a very, very long process, right? Because of the risk involved and wanting to ensure that everything is done properly, right? Well, it's the same thing in the audit field. It takes a long time to develop the level of professional risk required to complete the work properly. Now, when auditors review the internal control system and determine whether controls are strong or weak, then they have to do what's called a linking, right? We have to link our assessment around internal control and the audit assertions to the detailed substantive procedures. So this is in, if you look at Exhibit 11-5, which is on page 465 in the text, okay? You'll see on the left-hand side, it has the account. Now the account balance they show you on that page is cash. Remember, of course, cash is part of the receivable revenue receipt cycle, right? By receipts, we're referring to cash receipts. And if you look down the left-hand column, right, it talks about the various risks. Okay, so we have risk over existence, completeness, etc. And in the middle of that page, 465, you see is risk assessed as high, moderate, or low. Right? So auditors, based on their review of the internal control system, will determine if the risk is high, moderate, or low. And you'll see there's a check, right, in the various boxes for each of the assertions. Then, depending on their decision around the assertion, they're going to determine whether they have to do which type of substantive procedures. Okay, so on page 465, you see the information there for sales. And if you turn over the page, you'll see that it continues on. At the top of the page, it says example of audit program responding to assess risk. So let's look at that for a minute, just to help you understand it. At the top of page 466, okay, you see there's it says substantive audit procedures, and there's a whole list, right, of substantive audit procedures that goes over to the next page. Okay, and so in the second column from the left, you see it says assertions for cash balance, okay, related to E, C, etc. So that's existence, completeness, okay. So those are the various audit assertions. The timing column tells you when the auditors are going to do their substantive procedures. The extent, that's how many items you're going to look at. So in many of the boxes, you see it says 100%. In some of the boxes, it lists a number of items. We're going to look at 10 items or 15 items, right? And then to the right-hand side, you see it has a working paper reference, right? So that's just where in the auditor file can you find the substantive work that they've done, okay? So on going back to page 465, right, the auditors determine whether control risk is high, moderate, or low with respect to each of the audit assertions listed there. And then depending on what their conclusion is there, on the next page, 2 pages, 466 and 467, they decide which of the substantive procedures are they going to do and to what degree, okay? So the link that they're talking about in the text is page 465 is the internal control assessment, and then based on the assessment, they're going to do the procedures as noted on page 466 and 467, okay? And so it takes, right, a long time to assess the internal control system, and then even to do the linking, right, it takes a long time because you're using your professional judgment to decide which procedures you're actually going to do. Going on to PowerPoint 27, says the audit procedures to gather direct evidence on the account balances, sales, accounts receivable, are called the substantive procedures. Again, we talked previously about what the substantive procedures are. We recalculate data, we observe, we confirm, right? Confirm accounts receivable. We inquire, we ask management, right? We vouch, trace, scan, do analytical review. So these are all, right, substantive procedures that the auditors do. And those are the procedures on page 466 and 467. Again, the auditors are deciding on those substantive procedures based on their assessment of internal control documented on page 465, okay? So that's the link. Now you can see, if you look at page 465, right, it doesn't say, okay, if internal control is weak in this area, do substantive procedure number 1, 2, and 3. It's not that type of linking. You're simply looking at page 465 and making an assessment, right, in each of the audit assertions whether internal control is high, moderate, or low, and then based on your assessment, deciding on the next 2 pages, 466, 467, what do I think the extent of work is that I need to do in each of the areas, okay? So it's a conceptual link, right? It's not a mechanical link where you say, given these 3 control weaknesses, here are the 3 substantive procedures I have to do, right? It doesn't work that way. You have to use your judgment, right, in determining which substantive procedures you're going to do based on your assessment of internal control in each of the audit assertions. Right? So it takes some time, right, to develop the level of skill to be able to do that type of work satisfactorily. Okay. When you're doing substantive procedures, they discuss this on page 471. Okay. Now, I'll just point out on page 469, okay, there's a internal control assessment summary form, just like on page 465, except the one on page 469 is for accounts receivable. Right? So that's another part, of course, of the cycle. Okay. And then over on page 470, at the bottom, exhibit 11-7, that's the substantive procedures for sales. Okay, so you've got substantive procedure forms in the text for cash, accounts receivable, and sales based on the internal control assessment done by the auditors. So that's the linking that's done. Assess internal control. Is control risk high, moderate, or low? And then depending on your assessment in each of the audit assertion areas, you do appropriate substantive testing. Okay, and again, the 2 problems that I've assigned you to have a look at, discussion case 11-4 and 11-5 will help you with respect to development of your knowledge around internal control assessment, right? And determining whether internal controls are weak or not in specific situations. And we'll be talking more about that as we go through the course as well, of course. Okay, now there is something on page 471 called a continuity schedule. And a continuity schedule, it's very straightforward in terms of what it is. You can see in the PowerPoint. If we talk about accounts receivable, okay, auditors do this type of work quite a bit because it's an easy way to do analytical review. Remember, analytical review is part of the substantive procedures that auditors can determine that they want to look at. So a continuity schedule would simply be, as they indicate at the bottom, you take your accounts receivable balance, for example, at the beginning of the year, let's say it was $10 million, you would add to your accounts receivable, right, additional revenue generated from credit sales. So $20 million, let's say our credit sales during the year were $50 million. So we had 20 million owing from customers at the beginning of the year. We add 50 million, right? So now our total accounts receivable are 17 million. Then we're going to deduct from the account receivable cash that we collected from our customers. So let's say that was 60 million, right? So 70 million minus 60 million would be our 10 million, and then at year end we have to say, can we collect the entire $10 million or not? If not, we have to write off some of those accounts receivable, right? So let's say if we can't collect $100,000 out of the 10 million, we're going to make a journal entry, debit bad debt expense, right, in either credit accounts receivable if we're going to write off the amount, or credit the allowance for doubtful accounts if we're going to simply provide for a future loss on some accounts receivable. So in that case, our net account receivable balance would end up being, right, $10 million. If we wrote off the account receivable minus 100,000, it would be 9,900,000. And so auditors will look at this continuity schedule, compare it to the prior year, right? Or you could do a continuity schedule for a month, right? Take your December 1st balance, add your December credit sales, minus your December cash collections, minus any accounts written off. You would get your accounts receivable at the end of the month. So you could do an analytical review to see how the accounts receivable balance changed during a month, during a quarter, during a year. You could compare multiple years together, right, as part of your analysis to see the trend, right, in accounts receivable, and that could potentially point out errors, right, that have occurred in the accounting records through a comparison simply by looking at a continuity schedule. So this is a very common form of substantive procedures that auditors do. Why? Because it's very efficient, right? It's easy to do, doesn't take a lot of time, and gives you good quality audit evidence in terms of how the numbers are moving. Remember, we talked about knowledge of business. If data moves in a certain way and you have a good understanding of the business, you can determine, right, whether the numbers appear to be reasonable or whether they indicate that there's a problem, right, because the continuity schedule doesn't quite look right. Right? So, for example, if you did a continuity schedule, let's say for the month of December, so your beginning receivables, for example, were $10 million at December sales. Okay, so let's say December sales this year were $1 million. So now you have $11 million, and then minus your cash collected from customers, let's say that was $2 million. So you end up with $9 million in your accounts receivable, okay, assuming there's no receivables written off. But now we compare that to the continuity schedule last year. Last year we started off with 10 million as well, but in December last year we had $3 million in credit sales. So the auditor would ask themselves, why are credit sales this year only 1 million when last year they were 3 million, right? That's an indication maybe there's some unrecorded sales this year. Maybe last year's sales in December were extraordinarily high for some reason. That's a material difference, right? We have to investigate to see if the numbers appear reasonable or not. Right? So just that type of high-level data analysis can be very important to an auditor and satisfy themselves that the data is correct, right, in terms of what's been recorded. Okay, and that's again why they're emphasizing here analyzing financial statement relationships. Another common procedure auditors would look at would be if sales went up 30% this year, what happened in our accounts receivable? Did our accounts receivable go up 30%? You would expect so, right? Because sales and accounts receivable are in the same accounting cycle, right? So if our sales go up 30% from, let's say, 50 million to 65 million, we would expect our receivables at year end to increase from, let's say, last year's balance of 5 million to 6.5 million. But if our sales went up 30%, but our accounts receivable, let's say, went up 40% from 5 million to 7 million, we would want to investigate what happened, right? If our sales only went up 30%, why did our accounts receivable go up 40%? You would want to investigate that. Maybe there's some accounts receivable that are not being collected. Maybe there's some customers in trouble. Maybe, right, we have to provide for increased bad debts because the customer balances appear unreasonable, right? If sales go up 30%, accounts receivable should not go up 40%, right? It should only go up approximately by the same percentage that sales go up. So again, auditors look at trends, right? Knowing the accounting cycle, if sales go up 30%, accounts receivable should go up 30%. If sales went up 30% and accounts receivable did not move at all, right, did not increase at all, why would that occur? That would not appear reasonable either, would it? Maybe someone has stolen money from the company, right? Credited accounts receivable and debited bad debt expense, and somebody stole the money internally. Right? You would have to investigate that to determine why is the movement in the balances within the same cycle not consistent. Right? So again, if sales go up 30%, you'd expect accounts receivable to go up 30%. If it went up 40%, that's a problem. If it went up by some amount significantly less than 30%, that can also be a problem. Right? So you have to investigate to determine why those movements occur. Again, you do that simply by looking at continuity schedule, right? An analysis of the extent of movement in the cycles, balances, sales and accounts receivable within a particular accounting period. A month, right? Compare this month to the same month last year, compare the last quarter of this year to the last quarter of last year, or do it on a total annual basis so that we can understand, right, what's happening in the client's business, okay? And of course, the idea is by analyzing these financial statement components, right, you can determine what is the impact of misstatements that would be discovered through your analytical procedures, right? So if sales went up 30% and accounts receivable went up 40%, let's say from $5 million to $7 million, but they should have only gone up by 30%, which would be $5 million to $6.5 million, then you know the impact of the misstatement might be $500,000, right? The difference between $700,000 if there was a 40% increase and $6.5 million if there was a 30% increase, right? So you can determine through your procedures the possible impact of a misstatement, right, through your analysis. So this is very powerful, and it doesn't take a lot of time to do. Right? So again, you can see why auditors like to do analytical procedures. You can look at the forms, right, that we've looked at, Exhibit 11-A, the internal control forms, on pages 465 through 470. It takes a lot of time, right, to do that internal control analysis. So auditors always have to ask themselves, is it the proper approach to analyze internal control and try to limit our substantive procedures to analytical review, just like we're talking about right now. This is exactly what the auditors try to do. Okay, they try to limit their audit work to internal control assessment plus as much analytical procedures as possible. They always will do some tests of detail as well in terms of looking at actual accounting documents, but they try to minimize the tests of detail because that takes a lot of human effort. And when something takes a lot of human effort, it means it takes a lot of time, right? If it takes a lot of time, that means you're going to have to bill their client for more money. Okay? Excuse me for a minute. Okay. So again, analytical procedures, very efficient, very powerful in terms of the ability of these procedures to determine potential errors in the accounting records. Okay. Now we mentioned earlier the other day when we're looking at the sales or revenue receivable receipt cycle that the auditors place a lot of emphasis in this cycle on the existence, assertion, and rights. Okay, rights means do we have a right to the asset? And with respect to those two assertions, right, the main reason they put emphasis on them is because we don't want assets to be overstated. If assets are overstated, it means there should have been an amount written off, perhaps, to the income statement, right? And so if there should have been an amount written off to the income statement, which is not yet corrected, it means the income is too high, right? Oh, if the income is higher than it should be, and the difference is material, right? That means there's a material error in the financial statements. The auditors could be sued for that. They don't want that to happen. So they put a lot of emphasis on the existence of assets, right? Because if they don't exist, they should be written off. And not only do the assets exist, but do we have a right to realize the asset, right? Because for accounts receivable, for example, does it exist? And then even if it exists, do we have the right to the money when it comes in? Or does that money, for example, have to go to the bank? Right? If the money has to go to the bank, we should indicate in the financial statements that the accounts receivable, right, are used as security for a bank line of credit, right? Because that means when we collect the account receivable, the money has to go to the bank, right? We don't get to keep it in our own bank account. Okay. Now, the types of substantive procedures that auditors will use, right, to verify the assertion of existence and rights, that's what they talk about in this particular PowerPoint number 30. So we can do recalculation, right? For some assets depend on calculations. So they talk about prepaid expenses, right? So if a company has prepaid rent or prepaid insurance, we can simply check the client's balance by doing a recalculation, right, of the prepaid amount. Of course, with respect to existence of assets, we can also inspect, right, visually see physical assets. So that type of test is, of course, done typically for inventory, okay? Or if we own buildings, where is the building, right? And not only where is the building, maybe we can see the building, but do we have the right to the building? Well, we want to look at documentation, right? The deed. Is the deed in the name of the company or not, right? Who actually owns the building? Do we own the building? If we can physically see it, hopefully so, but maybe there's a problem with title, right, on the physical asset where the company doesn't have the right to the building, or someone else holds a mortgage, right, on the building. So recalculation of amounts, physical inspection of assets. Now on accounts receivable, in this particular cycle we're looking at, right, when we look at the balance sheet, what are the two main accounts in the revenue receivable cycle? It's accounts receivable, right, which for money which is outstanding from customers at the end of the financial statement period, and the bank account, right, how much money is in the bank account. So the substantive procedure to verify the existence and the company's right to those assets is confirmation, right? The client will sign a confirmation for the auditor to send to their customers and to the bank to verify the balance as being correct, right? And the other day we mentioned in the text the pages where you can look to see if there's the pages in the text for the bank confirmation form and for the accounts receivable confirmation as well. We're going to talk a little bit more about that in a minute. Inquiry, of course, is a very powerful tool as well. When in doubt, ask management, right? So we can ask management, are your accounts receivable pledged to the bank as security for the line of credit? Are there minimum balances in the company's bank account that the company must maintain on an ongoing basis, right, in order to keep the bank happy? So, of course, we can get a lot of information from management. And we know from our study before the midterm, management, if they have information, they have to give that to the auditors, right? They can't hold it back. So when the auditor asks them a question, they have to be honest and forthright in their answer and explain what's happening. Inspection of documents, I've already mentioned that. For example, to verify title, right, over land and building. But you could also look at documents if you have used your accounts receivable to secure a line of credit with the bank. You can look at those banking documents, right, to see that, yes, the accounts receivable does serve as collateral to the bank for the amount of money that's been borrowed, okay? In addition, of course, it mentions when you're inspecting documents, it talks about scanning. So remember, scanning is just a high-level review, basically. So high-level review, if we're looking at accounts receivable, we might say, are any of those accounts receivable due from related parties? Right? Because we know amounts due from related parties must be separately disclosed under IFRS in the financial statement. Are there any balances in accounts receivable which look unusual? So for example, if we made a loan to the CEO, that's not an account receivable, right? That has to be separately disclosed. And by the way, why did the company make a loan to the CEO? Right? It raises more questions that the auditor has to investigate. Right? So just by scanning of accounting records or scanning a list of accounts receivable, we can look for related parties. We can look for unusual amounts. So for example, if the client gives you a list of accounts receivable and there's a credit of $100,000 in one of the accounts, that's unusual, isn't it? Why would an account receivable, which is normally a debit balance, why would it have a credit balance in one of the accounts, right? It looks unusual, and if it's material, you would have to investigate it, right, to determine, is there an accounting error, right, in place, or why is there a credit balance in a customer's account? Analysis, again, I've already mentioned, essentially that's done with the continuity schedule, right, comparing data, how data has moved this month versus last month, this month versus the same month last year, this quarter versus the same quarter last year, right? Lots of comparison going on so that the auditor, using their knowledge of business, can discern, do the numbers appear to be correct or not? So again, all this type of analysis is giving the auditor what? Audit evidence as to whether the accounts receivable, sales, and cash balances are correct or not. Now we're going to talk for a few minutes about the confirmation process and actually the use of confirmations. Again, the confirmation forms that we're referring to on page 475, you'll see the bank confirmation form. So please do have a look at that. Okay. Very common. Bank confirmation forms are the same. Doesn't matter what country you're operating in. The auditor's forms are always the same. Okay. And there's an example of a completed one on page 476. Okay, so 475 is the blank one. 476 is the response in terms of what it would look like when it comes back from the bank. And then on page 478, there's an example of a confirmation letter going to a customer, what we call a positive confirmation. Again, we'll talk about that in a minute. And then the other form of confirmation that we've mentioned before, page 479, the negative type of confirmation. Okay, so we'll talk about these for a few minutes here. So on this PowerPoint, number 34, it's talking about the fact, it says confirmation is considered to be a required, generally accepted audit procedure, right? If you're an auditor, you would not want to go into court, right, not having done some amount of confirmation work. Okay? Confirmation is a generally accepted audit procedure. And related to what? Well, cash, right? So a company says it has $10 million in its bank account. Does it? Well, you send the bank confirmation form, right, on page 475. The client signs it and asks the bank to complete it and return it to the auditing firm with a copy to the client. Okay, so that bank confirmation form, it's used to confirm the amount of money in the customer's bank account, right, in your client's bank account, and as well the amount of any loan balances. Okay, but there's a lot of other information given in the bank confirmation as well. So corporate guarantees, for example, where a parent company has guaranteed the bank debt of a subsidiary. That's disclosed on the form as well. It's also disclosed in the bank confirmation form if your client has pledged, right, accounts receivable and usually inventory as security for the bank line of credit, okay, which is advanced to your customer. So there's a lot of information that comes back on the bank confirmation form to the audit firm. The audit firm will receive the bank confirmation form that's been completed, for example, on page 476, right, the completed form, and then they'll take that data and agree it to the client's accounting records, right, to make sure that their accounting records reflect the same amounts that are reflected in the bank confirmation. Excuse me. Okay, so the bank confirmation form, again, very standard procedure. It's done on all audits. Okay, it's that generally accepted. It's always done. And again, this PowerPoint, they're just referring you to page 475 and 476. Okay, for accounts receivable, of course, accounts receivable confirmation are confirmations which are going out to the customers, right, of your audit client. And you're sending out these confirmations because you want to verify, right, that the accounts receivable actually exist and that there's a right to collect the money from the customer. So existence, right, is an audit assertion made by management. Valuation is an audit assertion made by management. So the auditors will attempt to verify, does the account receivable exist and is it properly valued? So existence, they're going to use confirmations, right? So either a positive confirmation or a negative confirmation. Now, most of the time, positive confirmations are used, right? So positive confirmation, again, that's on page 478. A positive confirmation, auditors always have to get back from the customer, okay? If you do not receive the positive confirmation in return, the auditors must do what's called alternative procedures to confirm the account receivable balance. So, for example, alternative procedures, you send out a confirmation letter asking the customer to confirm a balance. If the customer does not confirm the balance, then the auditor will look for subsequent receipt. Right? If the customer actually paid the account receivable balance after the end of the year, that's a pretty good evidence, isn't it, that the amount was receivable. If the customer paid it in January, given a December year end, that's a good indication that there was a receivable at the end of December. In addition, if the customer has not yet paid, right, the account receivable, you can actually go to the client's records and look at the shipping documents and the invoices, right, to build up the account balance to ensure that the amount is receivable because the goods were actually shipped to the customer. Now, before you do all that extra work, normally what's done, because it's easier and more efficient, if a customer does not respond to the first confirmation letter, you'll send a second one out. Okay, so auditors call that seconds. We'll send seconds. Well, they do that because it's more efficient, right, than doing some of these other detailed procedures. Doing alternative procedures, like looking for money coming in from customers or building up account balances by looking at sales invoices and shipping documents, that takes a lot of time, right? So auditors try and avoid that by getting a written confirmation. If they send out a second and the customer still doesn't respond, very often they'll say to management, give me the phone number, I'm going to call the customer. Right? So sometimes you can actually call the customer, talk to their accounts payable department, and get a confirmation over the phone, and then ask the person, right, to get the confirmation signed and returned to you, or even send them a third copy, right? That's always the most efficient way, and it's the best form of evidence, right? When you get an actual document back from the customer saying, yes, we owe the money. Now, what happens sometimes is when confirmations come back, a client might say, a customer might say, we don't owe the money, or they might say, there's a problem with the invoice amount. Right? Well, that's an indication maybe, right, there's a valuation problem. Maybe the wrong price was used when the goods were shipped to the customer, right? So there should be an adjustment made for that. The entire account receivable balance is not going to be collected, so this goes to valuation. Sometimes I had this happen. You send out a letter to a customer, right, to confirm the balance, and it comes back the customer's bankrupt, which means the whole amount should have been written off, right, by your client. Maybe they missed it. Maybe they intentionally didn't write it off because they didn't want to record the expense, right? So you can get a lot of good information back from these confirmations. And of course, that's why auditors usually press to try and get something in writing back from the customers. Now, depending on the size of the account receivable balance and the number of accounts, you might use statistical selection methods, right, to determine which accounts are you going to collect. So, for example, if your audit client has accounts receivable of $100 million, well, how many accounts consist of that $100 million? If it's one customer for $100 million, you just have to send out one confirmation, right? That's very efficient. On the other hand, in that $100 million, right, if there's 100 accounts or 1,000 accounts, well, you don't have to send out a confirmation letter to every account. You will look at the detailed accounts receivable and make a selection, either judgmentally or statistically, right? If there's 1,000 customers that make up the $100 million, you use a statistical method to make a selection, right, out of 1,000 items. And then based on your sample, right, so you might confirm 10 million out of 100 million. If they all come back, the confirmations all come back and they're correct, well, that's 100% rate, right, where the customers say, yes, sir, we agree. So that's good audit evidence. On the other hand, if 10% of them come back and say there's a problem, that 10%, so 1 million out of 10 million say, no, it's wrong or there's problems, well, then you take that error percentage, 10%, and say 10% times the population of 100 million. That indicates there's a potential problem of $10 million. that might be material, right? And so then it means you have to do even more work, right, to try and define, is there a $10 million problem, or is the problem something less than $10 million? Okay, so this is what you want to look at in terms of verifying existence, right, over accounts receivable, and to try and gather evidence about valuation. Valuation, though, the other thing you look at is an aged accounts receivable balance, right? So you break down the accounts receivable. Is the invoice current? Is it 30 days old, 60 days old, 90 days old, 120 days old, more than 120 days? So you break out the accounts receivable that way. Most clients, of course, do an aged analysis, right, every month, so they know if there's issues or not. You look at it as the auditor, so you can see the aging and are there old accounts that haven't been paid for which an allowance should be made, right? So the aged accounts receivable analysis is very important that the auditors use to determine valuation, right, of accounts receivable. Now, the last point on this PowerPoint, it says confirmation will not provide sufficient evidence regarding ownership. Okay, so a client might have an account receivable, but do they own the account receivable? Maybe, again, the account receivable has been pledged, right, to the bank. So the bank has a claim against the account receivable. Okay, so in that particular case, you have to disclose, right, in the financial statements that the accounts receivable act as security for the bank loan. So when the money comes in, the money goes to reduce the bank loan, right? The money doesn't come into the company and we get to keep it in our bank account and leave the bank loan outstanding, right? Lines of credit don't work that way. As money is collected, the line of credit has to be reduced, right? So the bank's exposure, it increases when amounts are billed, it decreases when amounts are collected, right, from customers. So that's why, again, the bank confirmation is so important. It's going to disclose, right, whether the accounts receivable have been pledged or not to the bank. And normally accounts receivable and inventory are both pledged. So that's important information, right, from the bank confirmation. Okay, PowerPoint 37 here, we're talking about positive confirmations. Again, the positive confirmation letter is on page 478 in the text. As I mentioned, when the auditor sends this out, they must get a response in all cases, right? So you have to determine, is the balance correct or is it incorrect? As it suggests here, when there are individual balances that are large or where amounts are in dispute, you would use a confirmation, right? So out of that $100 million, if there's only one or two customers, you use positive confirmations because you want information back. The amounts are large, they're material, right? High risk, so you definitely want to hear from the customer. Or if amounts are in dispute, right? There's $100 million of accounts receivable, but 90 million is in dispute, and you're aware of that. You're going to send a confirmation letter, right, to that customer to verify that they agree that the balance is correct, or if there's a problem, what the nature of the problem is. Okay. Now, when you send out a confirmation, there's two ways to do it. You may ask for confirmation of a balance. Okay. So let's say you send a confirmation to customer A, and customer A owes $10 million. So you can ask the customer, please confirm the balance of $10 million, right, is what you owe. Or rather than doing that, we use statistical methods to select information to be confirmed. You might do what's called specific invoice selection. So that client might owe you $10 million, but rather than confirming the balance of 10 million, you select 5 invoices within the 10 million and have the client confirm that. That approach is used where you have made a statistical selection through all the outstanding invoices, okay, regardless of who the customer is. It's not used that often. Most of the time, because of efficiency, you confirm balances, okay? It takes a lot more time and effort and work to confirm specific invoices. So except in cases where there's thousands of customers, right, confirmation of specific invoices generally is not done. Positive confirmations from customers, of course, are considered high quality audit evidence. Why? Because it's information from outside of your client, right? It's third party evidence. So high quality. And because it is high quality, that's why you must, as the auditor, get a response, right, from the customer. Again, if you can't get a response, send out a second confirmation. On occasion, even thirds are sent out. It's that important. If you still don't get it back, then you might have concerns about, does that customer even exist? You might want to look at business directories, right? Might want to look, are there any magazine, business articles written about that company, right, to verify that it actually exists. If it's in the same city, you might want to drive out to their business office and see if it actually exists or not. In addition, you can look for subsequent cash receipt, right? So if a client says, this customer owes us $10 million, and that's at December 31st, well, was it paid in January? If it was paid in January, that's pretty good evidence that it was outstanding, right, at the end of December. But if it's not paid by the end of January, it's more indication maybe there's a problem, right? And you might want to search further. Maybe that customer is in financial difficulty. Maybe they've gone bankrupt, right? So things happen, right? So it just means you have to definitely follow up when you're using positive confirmations. The other approach is the negative confirmation, again, on page 479. So when you send out positive confirmations, the letter basically says, our audit client says you owe them $10 million. If you disagree, please return this confirmation and tell us why. Right? So in a negative confirmation, it does not ask for the confirmation to be signed and returned to verify the balance. It says, just write back to us if you disagree. So very often what happens then, the auditor sends out negative confirmations and they don't get any back. Well, does that mean that the customer agrees with the balance? Maybe not, right? The confirmations might have got lost in the mail. You don't really know because you're not getting the confirmation back. So because you're not getting the confirmation back, as the PowerPoint says here at the bottom, the evidence that you collect from negative confirmations is less reliable. Why is it less reliable? Because you don't have any paperwork back from the customer, right? And it's kind of funny when it says evidence collected. What evidence did you collect? Nothing came back, right? So that is the evidence, right? Nothing came back. That's your audit evidence that those accounts receivable are collectible. But the fact that you don't have a third-party confirmation, right? That's considered fairly high risk approach, right? To use negative confirmations. Now, where they are used, as it points out here in the middle of the PowerPoint, says this approach is useful where inherent and control risk are low. So that means when a client's internal control system is very strong, okay, where there's a great number of customers are involved, so thousands of customers, okay, and the auditor believes that the customers will handle the confirmations correctly. Well, I'm not sure how you can gain that confidence, right, when you're not talking to the customer, okay? So I think that's a question mark on that one. But yes, this is when this approach is used. Control risk is low. So what type of companies have very strong internal control systems? Banks, right? Banks and financial institutions. So in the audit of banks and financial institutions, negative confirmations will be used in certain cases. So here's an example of when a negative confirmation would be used. So let's say you're auditing the Royal Bank of Canada. The Royal Bank of Canada have mortgages, right, that they've loaned against houses. So you would select let's say you're doing the audit for the Royal Bank for the year ended October 31, 2020. At that year end date, you would select all the new mortgages made that year and take a sample of those new mortgages and send out confirmations on the new mortgages, okay? But you would send out positive confirmations in that year. So in the year that a new mortgage loan is made, you send out a positive confirmation on that new mortgage loan. Then in subsequent years, that same mortgage loan is still outstanding, isn't it? Because it gets paid over 5 years or 10 years or 20 or 25 years. So the same loan is on the books, but in year one, you got a positive confirmation back from the customer saying, yes, we owe the money. So in subsequent years, assuming the internal control system is strong, and of course, because banks also have a large number of mortgage loans, the auditors will use negative confirmations on old loans. Right? Old loans are those that have been in existence for more than 1 year. So the auditors limit their risk that way. Right? For new loans, they'll use positive confirmations because they need high quality audit evidence. But for old loans, they will use negative confirmation, right? Because they have confidence that the receivable actually exists because in year one, they have a positive confirmation back, right, from the person that borrowed the money. So yes, negative confirmations can be used. They're very cost effective because you don't have to follow up the letter, right? In a positive confirmation, you always have to follow up to determine, right, you either get the letter back from the customer or you have to do alternative procedures. Negative confirmations, you don't have to follow up because unless the customer writes back, your assumption is the accounts receivable are collectible. Because why? Because there's no complaint. Okay, hi everybody. Sorry, my computer froze up there and I had to go out and come back into the classroom. So I'm going to repeat a little bit about the negative confirmations because it's an important point. I want to make sure that you got my message on this. So negative confirmations are used typically in the audit of banks and financial institutions. However, what auditors do is this. Let's say you're auditing the Royal Bank and the year end is October 31, 2020. Auditors will send out positive confirmations for new mortgage loans because auditors want high quality audit evidence for the first year on the new loans. But because mortgage loans are repaid, right, over many years, in year two, auditors will use negative confirmations. Negative confirmations are used because they can send out a large number of negative confirmations because they don't have to follow them up, right? Unless somebody writes back and says there's a problem with the balance of the mortgage loan, the auditors don't have to follow up. Remember, in a positive audit confirmation, they do always have to follow up, but not in a negative confirmation, okay? So again, the negative confirmations, very efficient, but only used in a financial institution audit in year two or later, right, of a loan. For the first year, the high risk is on new loans, so auditors will use a positive confirmation approach to have high quality audit evidence in year one. But in subsequent years, assuming internal control is strong, right, in that scenario, they will very often use negative confirmations because the risk is low because you actually have confirmed the account balance in year one. Now, just some background information on the actual audit process itself with respect to confirmations. The auditor, and this is discussed on page 480 in the text, the auditor has the control of the confirmation letters being sent out. And that ensures that the confirmations reach the intended customers, right? And that the customers actually exist. You don't want to let management send out the confirmations because they might change the name of the customer, might change the address of the customer, right? Send all the confirmations to the CEO's house or the CFO's house. The CFO confirms all the balances and sends the confirmations back. Right? There's actually been frauds conducted where that occurred. Right? So obviously you don't want that to happen. Excuse me for a minute. It's the second point. It says auditors need to be concerned with the confirmation response rate. The response rate is how many of the confirmations we sent out did we get back, right? So if we sent out 100 of them and we got 98%, we got 98 back, that's a 98% response rate. That's very high. That's an indication customers are happy, they're sending back the confirmations. On the other hand, if we send out 100 and we only get 10 back, the response rate is only 10%. Just on the face of it, it appears there could be a problem, right? Maybe the customers don't exist. Maybe the addresses are wrong, right? All of that might reflect fraud and or other errors in the internal control system. So where the confirmation response is poor, the auditor has to consider, maybe I should use alternative procedures, right? I should look for more cash coming in after the end of the year because the customers, for some reason, aren't responding. So if you don't get a confirmation back, and if customers are not paying after the end of the year, that could be an indication, right, that the sales recorded as receivables actually don't exist, right? Because the customers have not confirmed by returning the confirmation letter, and there's no money coming in the door, right, after the end of the year. So auditors always have to look at, are there high risk situations, and do we have to do some additional substantive work as a result of that? Again, looking for cash receipts after the end of the year is a type of substantive procedure. Now, confirmation of accounts receivable is not always done at the year-end date. So when you're working in large corporations, you'll see, for example, if the year-end date is October 31st, very often the auditor, assuming strong internal control, they will confirm at an earlier date. Most commonly, if the year-end is October 31st, the auditors will send out confirmations for accounts receivable at July 31st. Okay? And then auditors will use that information at July 31st, and what they do is roll forward that balance. So let's say the accounts receivable in total are 100 million at July 31st. Then they'll add in August, right, sales minus August cash receipts, add in September sales minus September cash receipts, add in October sales minus October cash receipts. That gives you the October 31st balance, right, in the general ledger, minus any accounts written off, of course. Now, that roll forward schedule, you compare to the prior year, maybe the prior 2 years, to detect trends, right? Just like we talked about earlier today. It's an analytical review, right, in terms of how the receivables have moved. In addition, the PowerPoint says additional procedures will be required at year-end. You may have a large new account, right, that arose in the August, October, September timeframe. So if it's a brand new account, which was not subject to the July 31st confirmations, you want to do additional audit procedures on that one account. So you might send out one confirmation at October 31 just for that new account, right? Auditors will do that, or they'll look at, did money come in after the year end to pay the account receivable balance on that new account, right? So new accounts will be an area of high risk, right? when you confirm receivables before the year-end date. But confirming before the year-end date is a very common audit procedure for large public companies because they do have strong internal control systems. Okay. Again, confirmations themselves, confirmation of accounts receivable, confirmation of bank balances is a generally accepted audit procedure. Auditors have to exercise care, of course, in ensuring the responses are received from real customers, right? So again, for the major customers, you may know companies that actually exist, like Apple exists, right? General Motors exists. We all know those are real companies, but you may have companies you never heard of before. Again, you might verify those by going to a business directory, looking at supplier magazines, right, to see if these companies are mentioned, looking for advertisements, right, search the internet, what can you find out about these companies, right? So there's various ways to determine whether these customers are real or not. And of course, assessing collectability, as I mentioned, you look at the aged accounts receivable schedule to see if there are valuation problems where customers are not paying. And for ownership of receivables, again, you're looking at the bank confirmation letter as to whether the accounts receivable have been pledged, right, as security. The last little bit of this particular chapter talks about auditing of the bank account of audit clients and of companies. Bank reconciliations at the end of the year are always audited 100%. And it's because when we think about a business and the transactions it carries on, all of the transactions of a business go through a bank account, right? It's like your own personal lives. All the money you make, right, goes into your bank account. All the money you spend comes out of your personal bank account. Same thing happens, right, in a company. All their sales get deposited to the company bank account. All the expenses they incur, all the assets they buy come out of the bank account. So there's a lot of activity, right? And so auditors are very concerned that the cash in the bank is actually correct. Okay, so the year-end bank reconciliation between the balance in the general ledger and the balance per the bank confirmation that comes back, audited 100% all the time. Cash, we know, is susceptible to fraud, right? And so this is another major reason the auditors want to ensure that the cash balance is correct. Okay, so one is concerned about fraud risk. The other reason is all of the accounting cycles pass through the bank account, right? Money coming in or money going out. Area of high risk, always audited 100%. Okay? And of course, the bank confirmations themselves are always sent out on every audit. Now, a couple of problems, as I mentioned in the text, again, you won't be responsible for this for exam purposes in the course, but they do point out a couple of problems in accounts receivable that you could have. The first one is called accounts receivable lapping. So this is a case where someone wants to take money that a customer has sent in, right? Steal it, put it in their own personal bank account. So that's called lapping. It says where receipts from one customer, so if customer A, for example, sends in $10,000, but that $10,000 cash receipt is applied to a different customer's account, right? So a check for $10,000 comes in from customer A, you put that in your personal bank account, okay, and you make a journal entry, okay, to credit a different customer's account, okay? And so, of course, that's a misappropriation, okay? The customer that paid the bill, eventually they would discover that, right? And they would contact the company, say, hey, our account wasn't credited for the $10,000 that came in. So what you would do is when the next check comes in for another $10,000, you credit the first customer's account, right? But you can see you're always going to be behind a little bit, right? You take $10,000 today, you don't credit the customer who paid it, you credit a different customer. Then when another customer comes in, you credit the first customer's account and you credit a different customer's account. You're constantly, we call it lapping, right? You're behind all the time trying to catch up. Eventually the fraud is discovered because usually the clients complain, right? There's a problem with respect to money not being deposited against their account receivable. The way you find that in an audit, as they point out here in the PowerPoint,
the audit should compare the checks deposited on the actual deposit slip, right, and trace the deposit slip to the customer account. So on the deposit slip, it'll say customer A paid $10,000. But if you look at the account receivable accounts and it credits customer B for the amount paid by customer A, that's an indication of lapping. Okay. Another situation that might occur is called check kiting. Okay, so that's where you write a check on one account where money doesn't exist and deposit to a second account. Okay, it says the depository bank does not know the check is NSF, and the deficiency will be covered by a second hot check. So, for example, you take a check, okay, deposit it at a bank. So this is a company that uses multiple banks. But when you deposit that check at the bank where you deposit in check doesn't know that it's NSF. Okay. Then you write a second check against that check that you just deposited at Bank A, let's say, and you deposit that at Bank B. So Bank B is going to, you deposit the check, take the money, but when they try and get the money from Bank A, the money's not there because it's a fraudulent check. Okay, it's already been returned. It's called check kiting. You don't see check kiting too much anymore, but because the banks know about check kiting, right, and they usually hold checks for several days now, if they're typically over $500, to prevent check kiting. There's a lot of fraud going on with respect to smaller amounts. So again, if you've run across banks holding checks for quite a while, it's because of check kiting. The last few PowerPoints here just talk about some of the problems at the end of Chapter 11. But again, I've already given you a few of those to look at. Discussion Case 11-4, Discussion Case 11-5. So if you haven't had a chance to yet, please do have a look at those. Okay, it'll get you used to looking at a fact situation and looking at for weaknesses of internal control. Again, this would be a common exam question where maybe if you do a small case and he asks you, what weaknesses in internal control do you see in this case? Okay, so this will get you used to looking for things. And as I mentioned earlier, this will also be part of the final group project that I'll be posting over the weekend for the groups as well to have a look at. Okay. So thanks everybody. If you have questions at all on anything I've talked about today, send me an email and I'll get back to you as soon as possible. Otherwise, next week we'll be moving into Chapter 12. Okay, same type of approach. We'll be looking at the audit forms that auditors use, and we'll be looking at a couple of the discussion cases out of Chapter 12 as well. Okay, thanks everybody. Have a good day, and we'll see you next Monday.